Thank you very much for attending, everybody. My name's Chris Rollins. I work with Steve specifically within the practice in the business development role. My background's in fact through debt collection for many years, and I've found this area of insolvency particularly fascinating, particularly as there are so many changes over this last 12 months or so, and soon to be more, I suspect. So look, just wanted to introduce Stephen for those who don't know Steve. Steve has had roughly 30 years experience under the belt with the insolvency, bankruptcy, liquidation, etc. We do a hell of a lot of this work. A lot of court stuff over the years, not so much last year, obviously, but also a lot of voluntary work as well. So this is new legislation and it's extremely interesting. So would you like to add anything, Steve?
No, just look, thanks very much for everybody attending today and taking half an hour out of your day to listen to us. This is a very interesting area. It's very new. And let's get underway, Chris.
Right, so it is being recorded. And if you look at the bottom of your screen, there's a Q&A section. So we're very happy to take questions. I'll ask them on your behalf at the end. And if we can't answer them, because it is brand new legislation, we'll come back to later on. So thank you very much. So just starting with the very first question, what is small business restructuring?
Yeah, okay. So last year was a particularly interesting year, particularly in the insolvency industry for those that practice in it. And there's a few of the attendees do. But for those that don't, there were a lot of insolvency restrictions that were put in place by the government, restrictions to winding up companies, to bankrupting individuals. You had JobKeeper in place. You had moratoriums for insolvent trading, and all those things initially were sort of going to come to an end sort of around September last year, and then they were extended on to December. And probably between September and December, there was a fair amount of consultation with the industry about a new form of sort of insolvency, which is this small business restructuring plan. So the government brought it in on the 1st of January, and what it's designed primarily to do is to save small business. And it's relatively, when I say small business, relatively, really small business. Give you an example, we've done one which got accepted, and that was a restaurant. And you can imagine the restaurant industry and the hospitality industry was hit particularly hard by COVID.
Right. So first of all, getting down to it, what are the eligibility criteria?
Yeah. So this is where it's really important. There needs to be a bit of work done with the practitioner. So generally speaking, what will happen is you'll have an accountant or a lawyer who'll come to you and say, look, I've got a client who thinks that basically they'll say, look, they're in financial trouble, they've got some issues. And you'll look at the various options available, and one of them might be a small business restructuring plan. Now, it's really important that the work is done up front before the appointment to make sure that the actual company, and this only applies to companies, doesn't apply to sole traders or individuals, only applies to proprietary limited businesses, is actually eligible to make itself able to use this particular bit of legislation. So there are 4 things that will knock a company out for not being eligible. So the first one really isn't that relevant at the moment, but maybe in years to come it might be, and that is that the director and the company haven't done a restructure of this sort within the previous 7 years. So at the moment, there really have probably been only a couple of handfuls of these plans that have actually been done. The take-up's been very, very slow in relation to it. And part of the reason for that might be because of the other eligibility criteria that I'm going to go through now. So the second one is that debts have to be under $1 million. So they include related party debts. So whilst a related party is counted in terms of the indebtedness to a company, related parties can't vote in relation to the actual restructure plan. I'll go through that a little bit later on. So debts have got to be under $1 million. Tax lodgements have to be up to date. And so when we come to do liquidations of SME companies, one of the things that we generally find that isn't up to date are tax returns. BAS statements generally haven't been lodged. You know, there might be a few quarters behind. We have a lot that are far beyond that. You know, they might have lodged them for a couple of years. And you find that generally in quite a few small business liquidations. The last eligibility criteria, which tends to knock quite a few companies out again, is in relation to employee entitlements. So they've got to be up to date, and that includes superannuation. And that's generally the one that knocks a lot of businesses out from being eligible to be able to use this. So, you know, it may very well be that you've got a client that comes to you, you look at the eligibility criteria. A lot of the companies may have actually bought their tax returns and lodgements already up to date because of JobKeeper. A lot of the work that accountants have done over the last 12 months in relation to that. But generally it's the super, and it might be that, you know, that's a relatively easy thing to fix up. It might be the tax returns is a relatively easy thing to fix up as well, which means that the company may be eligible then to be able to appoint a restructuring plan practitioner.
Great. So how does a small business restructure differ from a voluntary administration and subsequent DOCA?
Yeah, so they are similar in some respects. The biggest difference, so I'll go back a step. So for those that don't know how, say, a voluntary administration works, so administrator gets appointed generally by resolution passed by the directors, and the administrator takes control of the company, including its business. And if the business is sort of viable, assessments are done, then the administrator may very well trade that business on over a period of time. The administrator becomes personally liable for any debts that are incurred. Ultimately, creditors decide at a second meeting of creditors, and there's a big report that goes out from the administrator which details effectively if there's a proposal that's put up for a deed of company arrangement, it will compare what the deed looks like to what a liquidation would look like. And the administrator will make a recommendation, you know, primarily based on that the deed will offer a better return than a liquidation would. And so if the creditors decide ultimately to accept the proposal that's on the table, then a deed of company arrangement's entered into. The alternatives are that if the proposal isn't accepted, the company could go into liquidation, or the administration could come to an end, and that generally doesn't happen because the affairs of the company really need to be dealt with there and then. The big difference is with a small business restructure is the small business restructuring practitioner that's appointed doesn't take control of the company. So it's what they call a debtor in possession model. So the director continues to operate the company as normal. The practitioner that's been appointed is there to, you know, assist in the restructure of the actual business itself and help put a proposal together. They're probably the big differences, except that when you get to the end of it, if the plan is accepted, then that's one thing. But if it's not accepted, the company just goes back to where it was pre the appointment of the practitioner. So they're probably the biggest differences, Chris, between the two.
And it's designed to be less expensive, isn't it?
Yeah, that's right. That's a good point. I was just going to say that sometimes when you're dealing with a relatively small business, so give you an example, the one that we've just completed, which successfully went through, the restaurant. We were talking to that business sort of last year, and we were talking about voluntary administration, but the costs involved in doing a voluntary administration were prohibitive. And then when this bit of legislation came out at the start of this year, we looked at the eligibility criteria for this business, and it seemed to tick all the boxes. and therefore, it is much cheaper, significantly cheaper.
Right. So the next point is, can you just run us through the process and tell us how does it work, basically?
Yeah, okay.
What actually happens?
I won't get too technical at this point. If anyone wants to know the technicalities, we're happy to take that sort of offline. But I think it's probably more important just to actually talk through how it works in reality, the practicalities behind it. So you'll probably get a call as a practitioner. You get a call and you go and have a chat to the company and the directors who have got the issues, and try and work out what the best options are that are available. And if this option comes up, one of the very first things you do, as I said, prior to appointment, is you would have a look and see to make sure that it's actually eligible. You make sure that the tax returns have been lodged, the superannuation and super guarantee charge has all been paid. And of course, it's under $1 million worth of debts. So you have a look at all those things, and probably really what you're looking for as well, because there's some reporting once the practitioner is actually appointed that needs to go out within 2 business days. You work out what the debts actually are. You'll get a listing of their names and their addresses. You take the appointment, and at that particular point of time, there's a 20 business day period to put the plan together. And during that period of time, the practitioner deals with the director and assists in actually trying to put all this documentation, which at the end of that period of time is sent out to creditors, and then they've got 15 business days after that to actually determine by way of a postal vote whether to accept it or not. So it's the actual form that goes out to accept the plan is relatively straightforward and simple and short. It's a tick the box type form. Yes, you accept it. No, you don't. And then basically it's decided whether the plan is accepted is decided on the value of creditors that come back. So again, that's another difference between a VA and small business restructure, is that it's the actual vote is determined on value as distinct to number of creditors and value in a VA. So once that form comes back, it's in the affirmative, then the plan is deemed to be accepted, and the company's debts, I suppose, are sort of wiped from there, and they've got to comply with the plan. So during that period of the 20 business days, there's a number of things that the director has to do, a number of things that the practitioner has to do. So as a practitioner, what I've got to do is I've got to verify that the information that goes out is in fact accurate. So in a voluntary administration, we do a lot of work around, working out, determining what the assets of the company are, looking at transactions the company has entered into just to ensure that, see if they're avoidable. There might be an uncommercial transaction, unreasonable director-related transaction, an uncommercial transaction. So we look at all those sorts of things, and we report that to creditors. Under a small business restructure, we don't need to actually do that level of reporting. In fact, reporting is actually quite simple from a practitioner point of view, but we've still got to do that work because we've got to verify that the information that's sent out in the standard form that ASIC produces, that's actually accurate. Because if it's not, we need to make some comments in relation to that. We determine who the creditors are. We work with the director to determine what the plan looks like. So the plan can't go for more than 36 months. And it's got to be cash. It can't be, for example, that you might have a motor vehicle. You can't say, I'm going to give the motor vehicle to X creditor as part of the plan. It's actually got to be cash. I'll go through in a minute the other things that have got to be included. One of the things that the director has to do, a couple of declarations that need to go out. One of the declarations is to do with eligibility, that the company is in fact eligible. And the second one is that there are no transactions under Section 588FE of the Corporations Act. And very few directors know what that section actually is. And even if they could read that section, a lot of them are going to really struggle to determine whether there's any transactions under that. So again, the work that we do is to have a look to see whether or not there are in fact any transactions that might be covered in that. In the case that we had, there were a couple of transactions that we felt may have been recoverable under that section if the company went into liquidation. And then there was a disclosure made by the director in that declaration as to those transactions, the basis of them, what actually had happened. And look, in a nutshell, what it was some money that was put into the business to keep it afloat during the period of time that JobKeeper came, the eligibility for JobKeeper came in, and when the first JobKeeper payment was paid, and then that money was actually paid back. So, you know, the director, she felt that transaction was fine. But at the end of the day, if it went into liquidation, you know, a liquidator would have to have a good look at that transaction to determine whether or not it's voidable. So we look at those things. We also look at what the debts and claims in the of what they call affected creditors. So they're creditors at the date that the practitioner or the company goes into one of these small business restructures. So there's a couple of things that the directors can't do during that period of time. They can't dispose of assets during the 20, or basically the planned period, without the consent of the small business restructuring practitioner. They can if it's in the ordinary course of business, but let's say the restructuring practitioner and the director work together and they identify that there's, say, a piece of equipment that is idle, not being used, hasn't got really any purpose at all. And let's say there's an offer that is on the table in terms of realising that piece of equipment. In that particular case, because it might be in the best interest of creditors, ultimately, the practitioner may very well say, look, that transaction is fine to proceed with, but it needs the practitioner's approval. So those sorts of things are done. And then ultimately, a plan is put out. It includes with that a schedule of debts and claims that goes out to the creditors. And that's pretty important because upon a creditor getting that, they've got 5 business days to dispute the amount that's actually claimed. And then there's a process that they've got to go through if they do in fact dispute that particular debt. It's probably, we felt it was good practice when we did this to make sure that up front, when we first got appointed and within the 2 business days from appointment, when we put the circular out to creditors to tell them that the company had appointed a restructuring practitioner, that this was the debt that was owing to them, and to come back to us so that if there were any disputes, we were able to sort them out during the 20 business day period, rather than when you send it out and then you've got 15 business days in order to make a decision. So we thought that was good practice. And then the other thing is that we then got to verify the assets that are available to the company, the assets that are available under the plan. So one of the things that you do is you look at the balance sheet, and in particular, and in the balance sheet of the company we did, there was a director loan account. There wasn't a large amount that was owing, but as part of the plan that was put out, the director actually was going to repay that loan account within 7 days of the plan being accepted, and that money would be available to creditors, which is what's actually happened. So the other things that you identify the other assets there, and a restaurant, for example, has some plant and equipment. We've got the plant and equipment valued. In a liquidation scenario, the plant and equipment isn't worth a great deal. You're probably not going to pull it out because of the damage that's going to be caused to the premises that generally are leased. So that probably wouldn't have been available, and certainly wasn't available under the plan. And the company that we had 3 different bank accounts. Had a trading account which we used to continue as normal capital to run the business. It had a GST account which it paid GST collections into, so it was able to remit that to the tax office each BAS cycle, and also had an account where future booking deposits were put into. So whilst it wasn't a trust account, it was very similar to a trust account in that people who were booking future functions would pay a fairly sizable deposit to make sure they could get the premises. So again, all those assets weren't available. The other thing that we've got to tell creditors, and this is all in a very standard form that is lodged with ASIC and goes out to the creditors, is how we get paid. So initially, for the 20 business day period where you're putting the plan together, it's a fixed fee. Okay, the legislation says that's how it works. So it's a fixed fee upfront to do that bit. You can't go and back and ask for more. It's a fixed fee upfront. Then for the second part, if the plan is accepted, it's a percentage of effectively the recovery that's made, or the contribution that's made into the plan. So, give you an example. If it was 15%, you specify that in there. It's 15% of each payment that's made under the plan. The plan that we've got that we're doing, it's for over a period of 35 months. Therefore, the percentage comes out of each monthly payment that's actually made that comes in. You've got to tell creditors how often you're going to distribute the money. So in our particular case, we're going to distribute it once a year for effectively the next 3 years. The other thing is what the practitioner's got to do is has got to actually firstly verify that the company is eligible, but more importantly, verify that the company is able to, in the practitioner's opinion, meet the plan, meet the conditions of the actual plan itself. So in order to do that, what we looked at were cash flows and budgets over the next 3-year period the plan was in operation. We included the cash flow with the plan that was actually sent out to creditors so they could have a look at it themselves, and the director was quite happy to disclose all that information. And that's really all that's all that really the practitioner has to do. There's no big report that needs to go in. There's no there's no need necessarily to comment on what you get in the liquidation compared to the actual plan itself. The legislation doesn't cover that. There are some cases that have been heard in court where there's 2 cases that I'm aware of where there's been a winding up application made against the company, and then they've appointed a small business practitioner, put the plan together. In those cases, they've been able to adjourn those hearings off because the courts determined that it's in the best interest of creditors to actually have that happen. And I believe that in those particular cases, in order to prove that it's in the best interest of creditors, there is a comparison of liquidation compared to what the return of creditors would be under the plan. So in a nutshell, I think, Chris, I think I've covered pretty much how it all works.
Yeah, I just interested in, we received that unusual email at the start of that. I thought you might like to comment on that. An email of support from
yeah, that was interesting. Look, as a practitioner, a lot of the time the creditors are pretty unhappy. They're losing money. No one's happy when there's money outstanding. But the restaurant that we did, it was sort of very much a community-based restaurant, been around for a very long period of time. But it was interesting that in that particular case, one of the secure creditors actually did come back and said, look, we've been dealing with this director for years. We love the way that she goes about the community-based activities that she does. We offer the full support and hope that this plan actually gets accepted. And at the end of the day, in this particular one, where these plans work probably fairly well is where there's fewer creditors rather than more. In this particular case, the major creditor was the ATO. Just to give you a bit of an idea of the return, because it's all public knowledge, return was about 25 cents on the dollar. I don't know if they really work where you offer 1 or 2 cents on the dollar. I think that creditors would then sort of think, well, what's the point of actually agreeing with that? Some might, some mightn't. But where it's a decent return, and in a lot of liquidations, I know that creditors don't get that sort of return. And yeah, look, in this particular case, it was agreed upon.
You know, actually it was a great result. I think it's the restaurant's been around for a heck of a long time with a very ethical owner, so she's over the moon, I think. Questions. Another question is, what are the benefits to a director of entering a small business restructuring?
Look, I think the benefits are, if you can get over the eligibility criteria, I think the benefits that the business is actually saved. I mean, that's what it's designed to do. Keeps people employed. Government put it in place, I believe, for that particular purpose. Company doesn't go into liquidation. I suppose one of the byproducts of that is, if it does go into liquidation, the liquidator might look at insolvent trading. Those sorts of things. So if the business is able to keep going, then you don't have those sorts of issues.
Great. And lastly, what do you think the uptake will be of this option?
Well, it hasn't been good so far. It's pretty, there hasn't been a huge uptake in it. I know the government, I think, is looking at maybe ways of varying it. I'm not quite sure what they might be. Look, it's an interesting process. I think the fact that the practitioner still needs to do a fairly large degree of investigation type work, but really not report so much on that is, I'm not quite sure what the purpose of all that is, apart from to verify that the information given by the director is accurate in the company. So yeah, look, probably unless some of the criteria is relaxed a little bit, I think, as I said, the ones that really knock it out are the lodgement of tax returns and also the
employee benefits. Yeah,
employee benefits, the superannuation in particular, tend to be the things that knock it out. And I doubt whether the government would relax, in particular, the super component of it, because at the end of the day, it's not the company's money, it's actually employees' money, superannuation. So yeah.
Certainly, just as an observation, I think the accountants and so on and organisations we've been talking to, a great benefit is that the idea of the director remaining in control, I think, is something that's very appealing to them. So
yes, spot on, because that lowers the cost of doing one of these, but also, the directors remaining in control, I think, is one of the benefits of actually appointing a small business restructuring practitioner.
Great. Well, that pretty much brings us to a close, 2 minutes early. Look, there are no questions at the moment. Would anyone like to pose questions, please? Or you're welcome to do it afterwards also. But just quickly, we've been very pleased with our Red into Black webinar series. I don't know how many we've done now, but there's been quite a lot. And some very well attended. This has been well attended also. We're pretty happy with it. Next month, we're running one with an ANZ bank economist speaking. It's titled An Economic Update from Recovery to Expansion. So that should be quite interesting, I think. That will be recorded. And then following that, we're hoping to have someone speaking to us about what the hell's going on with real estate in Australia at the moment, which is, let's face it, it's a phenomenon that's perhaps not been seen before. Now, we do have a question.
It's a final question. Can the business fix the eligibility criteria to become eligible, or is it all too late? Yeah, before appointment, they can fix the eligibility criteria. So, for example, if the tax returns aren't lodged, they can bring their tax returns up to date. That doesn't mean that they have to pay them, but the requirement is that the lodgements are actually done. If there's superannuation outstanding and there's the ability to actually pay that or other employee entitlements, if they get paid, then it fixes that eligibility criteria. So yes, the answer is those things can be fixed, but only prior to employment. You've got to be eligible. So if you're not eligible, it slips out and it just comes to an end. So, and there's, you know, there can be some penalties in relation to that. So you've got to be very careful. But I would have thought that the practitioner that's appointed will have done that homework well prior to taking the appointment.
Great. There's a comment from Len List to say, looking forward to the real estate one. Well, I've yet to have agreement from the party, but yeah, so am I. There might be a few questions there. So from Jason Qua, so a director can be liable for insolvent trading while the company is under the small business restructure process?
I would think so. Yeah, I mean the thing that happens when so there's a resolution that's passed, and the resolution similar to a VA resolution, that is that the company is unable to pay its debts as and when they fall due, or may become unable to pay its debt at some time in the future. So yeah, it probably is. There is that issue. I mean, there's this concept of affected creditors. Affected creditors are those creditors that are outstanding effectively at the date of that appointment. Creditors that come into existence after that date aren't covered by the plan itself. I hope I answered that question.
Are there any more questions? Well, in finishing, thank you very much for your attendance. This is being recorded, and our practice is to send out a recording to all attendees and all of those who couldn't attend. So that will be coming up. And also too, we've been running quite a few workshops on this and other subjects. We're always available for such events. But thank you very much for attending. Much appreciated.
Thanks for giving us your time today.